Hey Bowtie Nation, Joseph Hogue here, and some of the most frequent questions I get from you out there in the community are about income ETFs, dividend ETFs like the Global X NASDAQ Covered Call, ticker QYLD, the JEPI, and the RYLD, those specialized income funds with yields as high as 10 and 11% that just seem too good to be true. So I wanted to put together a video highlighting these, and I think a lot of you out there are going to change how you think about these based on what I found in the research. For example, the most popular of these 5 funds isn't the highest dividend yield or the highest return. The one offering the highest dividend yield, a dividend payout of 12%, wasn't the highest return either. Actually, the highest return of these income funds that we'll cover came from the one offering the lowest dividend yield. So in this video, I wanted to dig into those popular income ETFs, show you how each one works, what's in each, and which is best for your portfolio. I'll leave a clickable index in the description below to each income ETF, but make sure you stick around because towards the end of the video, I'll highlight the risks to each and which to buy for your needs. I'll use the ETF feature on StockCard to analyze the funds and what's in each. It's a new feature on the platform that allows you not only to screen for ETFs, but also see the details of any fund along with its top 20 holdings. As a special bonus, I've negotiated an exclusive discount for all you out there in the community. Use the promo code BOWTIENATION, all one word in lowercase, for an exclusive discount beyond the free trial. We're getting started, but I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Before we look at each of these individual income ETFs, I want to highlight why these funds are so popular and something to remember while you're deciding which is best for your portfolio. Each of these ETFs pay dividends on a monthly basis, and 4 of the 5 pay some of the highest dividends you'll find. Investors love that idea of getting paid each month, that consistency of cash flow, and who doesn't like getting paid as much as possible? That monthly cash flow doesn't come without risk though. The dividend payments from each of these are highly volatile. These aren't like most dividend stocks where the company tries to keep kind of a stable dividend amount and increase it over time. These income funds use special strategies to generate that cash flow and then pay out almost all of it out each month. That strategy might work one year to produce higher dividend yields, but not so much the next. So as we're digging into each fund, pay special attention to how each one works and if that strategy is something that you might want to add to your portfolio or hold off. Now finally, and all you out there in the nation are probably tired of hearing me harp on this one, but please just do not chase these just because of that high dividend yield. Now I'll highlight the total return on each of these, the stock price return plus cash yield, because often that highest yield is not going to be your best investment. Our first income ETF is the big one, the Global X NASDAQ Covered Call, ticker QYLD, with $3.3 billion in assets. Now, while this is the biggest and the most popular, it is not the highest dividend yield in the group at just 11% yield, or the highest return at an annualized 10.4% over the last 5 years, but this is still a solid fund. The fund uses a covered call strategy on the NASDAQ 100 index. Now that's the 100 largest companies in that tech-heavy NASDAQ index. So what it's doing here, it's buying the 100 stocks in this index, mostly those large technology-driven companies, and then selling covered call options against them. Call options give an investor the right to buy a stock at a certain price for up to a set date in the future, and for that right, they pay the other investor a premium up front. For example, if I owned shares of Tesla but was a little worried it might come down from that current $800 share price, or if I just wanted to create some cash flow from this non-dividend paying stock, I could sell a call option to another investor. So if I go to the call options here for Tesla, and you'll see the same thing on any investing app, I can sell these options with an $825 strike price expiring next month and receive $36.80 each. That's a cash yield of 4.5% on the current price, so generating that cash as well as protecting me from a little downside. But I still have that 2.5% upside potential to the $825 price over the next month. Now I know that's probably about as clear as mud to a lot of you out there, but I've got a full video explaining options investing along with my 5 favorite strategies that I'll link to in the description below, so check that out because options really are some great strategies for your portfolio. Now, that covered call option strategy helps the fund do 2 things here, and this is a theme that we'll see in most of these income ETFs. First, by collecting a premium, selling those call options to another investor, the fund generates that cash flow. In this case, most of those tech stocks don't pay dividends, so it's a great way to turn a portfolio of tech stocks into an income-producing investment. The strategy also does something else though. It also gives the fund exposure to that high-return NASDAQ, the fast-growing tech stocks, but lowers the risks just a little. You see, by selling those call options, the other investor is taking some of that risk that the stocks will fall. So the fund not only generates that cash flow, but is also going to be less volatile than just owning the NASDAQ 100 tech stocks outright. And looking at the stocks in the fund, it's a who's who of big tech companies with more than $500 million in shares of Apple alone, along with Amazon and Microsoft. But if you scroll down here, you see not all of these are tech stocks. You've got some shares of Comcast and Pepsi as well because they're also in that NASDAQ 100 index. Now, what you don't see here in these top 20 holdings, you can see in the fund's holding on its website. This is the covered call strategy it's using, so what it's selling to offset some of that risk and generate cash. And then digging into this, we see that the fund has sold call options expiring October 15th on the NASDAQ 100 fund, worth about $351,000 and covering 3,200 shares. And this is interesting because it shows you the exact strategy they're using. You see, the fund holds about 320,000 shares of the NASDAQ 100 in its net asset value of those stocks. But then it sells those calls covering about 1% a month. So it's sold call options for 3,200 shares of the index. Now that's generating some cash flow, though it doesn't limit the upside too much because it's only 1% of the fund. Pros of the QYLD ETF are that it's big and liquid. You'll always be able to buy and sell shares of the fund quickly because the daily volume is just so high. It's got a strong management team, something that we'll talk about more on these other funds, and it's a good balance between that high dividend and return. The downside to the QYLD may be that it's so heavy on tech stocks, which calling that a downside really depends on you. It is tech heavy though, and the limited covered call strategy won't protect the fund from a crash in tech stocks. For example, when tech stocks in the NASDAQ fell 8.6% in the 3 weeks late February this year, shares of the QYLD still fell 7.2% over that period, so it really only protected you from about 1% in losses. Another downside of the fund, and we'll see this in these other funds as well, is that in a rising market, the fund is going to underperform the stocks. Now that's because as those share prices rise, the investor buying the call options is going to exercise those, buying the shares away from the ETF at a lower price. You can see here that the QYLD in red, with its 3% loss this year, has underperformed the 12% return on the shares in the NASDAQ. That's just going to be the trade-off that you accept in exchange for that dividend yield and the lower volatility. This next income ETF, the Global X Russell 2000 Covered Call, ticker RYLD, is very similar to that QYLD strategy. Here, instead of holding those tech stocks, the RYLD is going to hold shares of companies in the Russell 2000 index, which are the smallest 2/3 of the stock market. So the focus here is going to be on that growth that you get from small cap stocks, but with the income generation through those covered calls. The dividend yield here is going to be the highest in the group at 12%, but it is not the highest total return. The fund has produced a 14.4% annualized return since May 2019, which is something you're going to notice about a lot of these funds as well. Most are fairly new with limited trading history, so it's really kind of difficult to say how well the returns are going to keep up. The RYLD uses that same covered call option strategy, but it does it in a very simplified way. Here, instead of holding the individual stocks in the index, like we saw with the QYLD, this fund invests directly in a fund that holds those stocks. Here we see that simplified approach, holding only the Vanguard Russell 2000 fund and then selling the call options against it. And just like that QYLD, it sold about 1 month call options worth about 1% of the assets. So right now, the market value of the shares held in that Vanguard ETF are around $484 million, and the fund has sold call options at a 22.30 strike price for $3.2 million, which is about 0.7% of the total fund value. So again, notice that these funds aren't hedging their entire portfolio every month. They might have fund assets of say 100 million, but then they're only selling covered calls against those worth 1 million, so generating about a 1% monthly income on the entire fund. Pros of the RYLD ETF are that you get that gross stock exposure to those small cap stocks, so a different group compared to the big company stocks that you'll see in some of these other funds. You also get that high dividend yield, the highest in the group here, though we're going to see that it's not the highest total return. The drawback to this fund, though, is because it does invest in that Vanguard fund instead of the individual stocks, you've really got kind of a double cost here, 2 layers of costs. The fund is paying an expense ratio of 0.1% on the Vanguard fund that it holds, and then you've also got the Global X costs on top of that. So this one is a little bit more expensive at a 0.6% expense ratio for investors. The JP Morgan Income ETF, ticker JEPI, is another popular one, though the dividend yield of 7% is a little bit lower. Just like with those other two funds, this one is selling covered calls for income, but here it's against those shares of the large cap stocks in the S&P 500 index. It pays a 7% dividend yield paid out on a monthly basis. And best of all, the expense ratio is the lowest in the group at just 0.35%, and the return of 23% is the highest of all five. The fund strategy is similar to that RYLD because a big part of its holdings are in notes that track the entire S&P 500 directly, but if we do scroll down, we see it also has positions in the individual stocks as well. These are all the largest companies in the S&P 500, and holding individual shares gives the portfolio managers the option to pick and choose and focus on some of these stocks more than they might be in the index. And that brings up one thing to understand about all these funds is the importance of a good portfolio manager. And unlike most ETFs, where the fund invests passively in stocks given an index to follow or a set of rules for which stocks it buys, these funds are actively managed. Now that means the portfolio manager is given more responsibility for picking those stocks and in this case, those options used as well. So the portfolio managers in these funds, not only are they picking those stocks that they think are going to produce the higher returns, but they also have to pick the option strike price that's going to maximize income but not give up too much return. And I think this is how that JP Morgan ETF has done so well, with the current managers Reiner and Zingone counting more than 60 years in the industry between the two of them and 40 plus years at JP Morgan. So then pros of the JEPI ETF are that it is a well-managed fund, evidenced in that higher total return versus the others in our list. It also gives you exposure to a broader set of stocks across the S&P 500 rather than just focused on a group like tech stocks or small cap. The downside here is probably that lower dividend yield, which is the second lowest on our list. The managers here have definitely given up some of that cash return in favor of the higher total return upside. That's 3 of our income ETFs down and 2 left, including some of the highest returns of the group. But I want to get your input on this as well. Now, every fund in our list pays out that volatile dividend, changing it each month depending on the cash flow. So my question is this: does that matter to you? Or would you rather the stable dividend payment that you get from some of the other dividend stocks so you know exactly how much you're going to get from month to month? Or do you want that potentially higher yield? So scroll down and let me know in the comments below, stable dividends or higher yield. Our next income fund, the Amplify Enhanced Dividend Income ETF, ticker DIVO, is the lowest yield of the group at just 5%, but producing a solid 17% annual return since 2017. The portfolio managers in the DIVO have quite a bit more leeway because the fund doesn't specifically track an index like the S&P 500 or the NASDAQ. The fund page says only that it invests in high-quality, large-cap companies with a history of dividend growth and uses that covered call strategy for income. And looking at those stocks held in the Amplify ETF, we see that while it doesn't focus on any particular index like the NASDAQ or the S&P 500 like these other income funds, it still is very much those largest companies in the market. Now this gives the managers a little more flexibility to pick stocks, but you're still probably going to track that S&P 500 index pretty closely because those are just the 500 largest companies. And here, looking at the rest of the holdings, you see where that covered call strategy comes in. The fund has sold about $70,000 worth of calls against shares of Apple, Caterpillar, and Visa, or about 1% of the total net assets for a 1-month expiration. Now, what's interesting here is how did the managers select those 3 specific stocks to sell calls against? I assume it's on some kind of valuation analysis that said that the upside in those 3 was limited. Also though, you see that the fund holds 10% of its assets in cash, which is going to be a major drag on that return potential, leaving that much money on the sidelines. Now, pros for that DIVO fund are that it does have that broader mandate. So if you believe in the skill set of the portfolio manager, they should be able to produce a higher return on just more flexibility. And that's come through in that 17% annualized return over the past 4 years, so it seems something is working right. The downside here is that the fund is managed by a sub-advisor to the company, a separate company called Capital Wealth Planning. So you have those 2 layers of management, and that's going to mean a higher expense ratio, just over 0.5% on the fund. Another downside for some investors is going to be a lower dividend yield. In fact, the lowest of the group at just 5% yield here, so you have to be willing to give up some of that cash return for the price appreciation. The Nationwide Risk Managed Income ETF, ticker NUSI, has the highest expense ratio of the group, but also an option strategy you don't get with the others. The NUSI invests in NASDAQ 100 stocks, just like with the QYLD, but this is the only one that uses a protective put options as well as that covered call strategy. Protective puts are where you buy a put option on a stock you own. That gives you the right to sell that stock for a certain price. So if the shares fall, you're basically locked in that price and are protecting your downside. The fund pays a 7.5% dividend yield and has returned 11.2%, but only in trading back through January of last year. And the stocks held in this NUSI ETF are going to look a lot like the QYLD because they both track that NASDAQ 100 index. So this is going to be all those largest tech stocks, and the others held in that index For example, Apple, Microsoft, and Amazon. And if you look through all the holdings on the fund website, you see the fund only has that one protective put and none of the covered calls. It's bought this put option that gives it the right to sell the NASDAQ 100 index in October at a price of $14,725 with a value of $61 million. So then what this put option strategy does, it gives the fund the right to sell the index for that price. And it turned out to be a pretty good bet here because it protected part of the portfolio from that 5% loss in the NASDAQ over the last month. The thing is here, this is not an income generating strategy like the covered calls used in the other funds. In fact, the fund had to pay money to buy these puts, so the fund managers will need to sell some covered calls here to keep that dividend yield coming, but they did do a good job of protecting investors from the recent sell-off. Pros of the NUSI ETF are that by using that protective put strategy, it can provide better downside protection because it's locking in that price. So this one might outperform in those big stock market crashes. Now the downside to that is the other side. It's that protective put strategy doesn't generate income. In fact, you have to pay for those options and it limits the yield a little. Now that's why we see the lower dividend yield and the lower total return versus these other ETFs. Check out that step-by-step options video linked in the description below, or click on the video to the right for the monthly dividend stocks that will pay your rent. 7 dividend stocks for cash flow every single month. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.